Hey, what's up guys? Sam here, and I'll be doing the free video for Friday, March 24th, 2023. So, as always, just finished doing the premium video for the fine folks in the gold room. And we took a very quick trip around the world, looked at a couple things. The market really hasn't changed too much from the last time you and I were together in these free videos. It continues to be kind of a tech focused market. It really is kind of the easy trade right now. The meme right now is that tech equals safety. I kind of have to chuckle to that idea that high beta, high valuation tech is safe, but who am I to argue with the market? But if we look at the technicals on the Qs, there's a dramatic difference here between the Qs and everything else. So if the Qs can take off the top here, basically call it 315, let's call it 313 to 315. If the Qs can take the top off of that level, they actually do have the structure here to try to do something, right? If you look at the weekly chart, you have a very nice kind of impulsive reversal signal. So when you have a down arrow like this and then you get up arrows immediately canceling it out, it kind of creates whiplash, identical to this. This is just in reverse. So here it gives you the false up and then the super strong whiplash lower. This is the same sign, same signal, but in the bullish fashion. And then aside from that, I mean, you do actually have a stack here on your moving averages. This is neutral, bullishly neutral, but you do have a thrust signal on your high-low. So you just got to close above 313 to about 315 on the QQQ, and I don't see a reason it would stop. If we go to the SPY, however, it looks a little bit different. Slightly. Ever so slightly. So on the SPY, you actually don't quite have that. Not quite. So with the SPY here, this is bearishly neutral. Remember, the Qs are bullishly neutral, and you actually had an up arrow. Here it's bearishly neutral, and when it's neutral of any kind, you typically want to follow the arrows. And those arrows are pretty overwhelming. You have a squeeze, you continue to have a weekly squeeze, and you have a mid-level sell in a bearishly neutral trend oscillator with a rather neutral to bearish structure on top of price, meaning that the 50 is sloping down. So you can see immediately kind of the divergence between the two markets. We can certainly explain that away by saying two things. One, rates have gone way lower, and tech of all markets likes lower rates, and that's probably set to continue, the lower rates dynamic. Now, we could argue that rates are going down for the bearish reasons, right? But at least so far the market doesn't seem to care. So that has a perfect feedback loop back into tech. I would avoid the inflation trade because of that same dynamic. And then the secondary is kind of a flight to safety, oddly enough. So the market seems to be viewing these mega cap tech stocks as safe. And you know, they've gone up 3, 4, 500 ATR, but the market still views them as safe. So in my world, what I explain in the gold room video, and I'll give this to you, is it really only makes sense to do one of two things in this market. So calling it the barbell approach. And on this end of the barbell, you're day trading. Now, what makes day trading attractive? Well, day trading is really attractive because if you've been looking intraday and you have the right indicators and you have the skill set for it, on a 1 minute signal, you can move 50, 60 points. You rarely will see that on a 1 minute signal. Usually it takes at least a 15-minute signal or something to get to that magnitude. So you can move 50, 60 points on a 1 minute signal, and then it reverses and you move another 50, 60 points against that original move. So you could theoretically catch 50 up, 50 down. And even if you're not necessarily catching the high or the low of that, if it's moving 50 and you can catch 30 up, 30 down, that's a hell of a day. So lots of advantages in day trading because of the volatility. And then the other end of the barbell is swing trading, but you have to make the adjustment to be about 3 to 6 months out. You know, the further away you go, the more conservative it will be, obviously. And then in the middle would be kind of the 1 week to 2 week stuff, which I don't think is going to work very well in this market, right? I do think, personally speaking, I think a lot of the opportunity is here in the day trading side of things. But if you just happen to be more of like a swing trader mentality, you have a job, you like to go play golf or garden, you don't want to be in front of the screens all day, then you can certainly subscribe to the swing trading point of view. I would just say to kind of minimize the bumps along the way when it swings 50 up, 50 down. Give yourself about 3 to 6 months to see the idea through. Aside from that, the only thing I would say is from a day trading perspective, you've gotten now 3 interventions in 3 weeks. For those of you that traded through 2007, 2008, it's even more aggressive now than it was then. So the question that has to be asked is, well, what do they see that they're so heavy-handed with their interventions? Literally 3 interventions in 3 weeks. The first one was Silicon Valley Bank, the second one was Credit Suisse, and then you had another one today based on the European banks. Their credit default swap started blowing out, and there was some headline about some emergency meeting. Lord only knows what they'll show up with on Sunday. They'll probably restart QE and cut rates on Sunday night. So when you have that dynamic, it kind of overwhelms the technicals a little bit, right? And when the technicals are overwhelmed by such a heavy thumb being placed on the scale, it really then feedback loops back into the original idea that day trading is the way to go. Because that way, you don't really care what they do, right? Now, my bias is obviously that they kind of lose control of this thing, but from a day trading perspective, you won't care, right? You could trade it up, you could trade it down. So this weekend, kind of something to do for yourself to improve yourself is sharpen your day trading skills a little bit, right? Maybe ask us some questions if you have any. Pop into one of our free room sessions, email one of our traders, read a book that you've wanted to read on day trading. Whatever it is that you can do this weekend to sharpen your day trading skills, I think will pay dividends for you over time in this market, because again, it's completely trendless, right? If you look here, where did we close? Here. Where were we? A few months ago. Here. Where were we a few months before that? Here. Where were we a few months before that? Here. We've gone nowhere, right? But there's been a lot of movement. So that movement, that volatility, is just the synonym as a trader for opportunity. But you have to be in a position to take advantage of it. So this weekend, sharpen your day trading blade. And if you have any questions, as always, drop them down in the chat. Before you go somewhere else on the YouTube, leave us a like. Subscribe if you're not subscribed. Leave us a comment. It does help us with the algorithm. And I'll see you guys next Friday. Have a great one. Cheers. Hey traders, this is Sam with Simpler Trading. I want to thank you for watching today's video. Hopefully you found the information in it helpful. If you did, leave us a like, leave us a comment. It really does help us out with the algorithm. And if you want to see us trade live with our own real money and be part of the community, come and check us out at simplertrading.com.